Most people think the 1929 stock market crash was just a bad week on Wall Street. It was not. It was the mechanical implosion of an entire decade built on borrowed money, blind optimism, and zero regulation. From 1921 to September 1929, the Dow Jones Industrial Average climbed from 63 all the way to 381. That is a 6 times increase in just 8 years. Everyone believed the party would never end. They were catastrophically wrong. When historians examine what actually caused the crash, 3 culprits emerge. First, the fuel, a speculative bubble powered by $8.5 billion in margin loans, more borrowed money than the entire United States currency in circulation at the time. Second, the spark, a 4-day panic between October 24th and October 29th, 1929, where an estimated $14 billion in paper wealth simply evaporated as leveraged investors were forced to sell everything. And third, the engine death, a fragile system of 24,000 unregulated banks that absorbed the shock and shattered, turning what should have been a sharp recession into a decade-long depression that wiped out 9,000 institutions, 3 failures, 1 catastrophe. Here is what Wall Street did not want you to see. While the stock market was roaring, the real economy was already fracturing underneath. The top 1% captured nearly 24% of all pre-tax income by 1928. Meanwhile, 60% of American families earned less than $2,000 a year, below the minimum livable wage. The S&P price-to-earnings ratio hit a historically dangerous 32.6 by September 1929, a clear signal the market was wildly overvalued. And in agriculture, which employed millions of Americans, farm incomes had already been collapsing for years. The boom was real on Wall Street. On Main Street, it was almost entirely an illusion. Here is how the trap was built. Investors were borrowing $9 for every $1 of their own money to buy stocks. Brokers' loans ballooned from $4.4 billion in January 1928 to $8.5 billion by October 1929. As long as stocks kept rising, everyone looked like a genius. Then, in late 1929, banks raised margin requirements to 40 to 50% overnight. Suddenly, those same investors needed to come up with far more cash than they had. Modest price drops triggered massive forced sell-offs. Those sell-offs drove prices lower. Lower prices triggered more margin calls. More margin calls triggered more sell-offs. The scale snapped, and it took everything with it. But the crash did not have to become a depression. That required human error on a monumental scale. In 1928, the Federal Reserve faced a choice. Let the speculation continue or tighten money to cool the market. They chose to tighten, aggressively selling government securities and raising the discount rate from 3.5% all the way to 6% by August 1929. The intention was to starve Wall Street of easy money. Instead, they choked the entire real economy. Construction collapsed. Auto sales fell. A genuine recession was already underway by August 1929 before a single stock crashed. Treating the symptom killed the patient. October 24, 1929, Black Thursday. The ticker tape falls hours behind as a record 12.8 million shares trade in a single day. Chaos erupts on the floor of the New York Stock Exchange. Then, at 1:30 in the afternoon, NYSE, Vice President Richard Whitney strides dramatically onto the floor and bids $20 million above market price for blue-chip stocks in a last-ditch attempt to stop the bleeding. It works temporarily. The Dow closes down just 2%, but it was only a delay. October 28th, Black Monday, the banker's pool fails. The Dow plunges nearly 13%. October 29th, Black Tuesday, 16 million shares traded, a 39-year record. The Dow falls another 12%. $14 billion in wealth erased in a single day. In 6 days, the world changed forever. Every catastrophe has its architects. 1929 had 3. Charles Mitchell, the salesman. He pushed risky securities to ordinary Americans, defied the Federal Reserve, and made $3.5 million personally in 1929 while paying 0 income tax. He was later indicted for tax evasion. Richard Whitney, the White Knight, the man who tried to heroically prop up the market on Black Thursday. Years later, he was sent to Sing Sing prison for embezzling from the NYSE Widows Fund. And Herbert Hoover, the president, who believed the crisis was purely psychological, who signed the disastrous Smoot-Hawley Tariff Act, whose name became permanently synonymous with the suffering that followed. Hoovervilles, Hoover blankets, 3 powerful men, 3 catastrophic failures of judgment. The stock market crash alone did not cause the Great Depression. It was the funnel of contagion that did. At the top, only 16% of Americans actually owned stocks. The initial drop hurt investors and brokerages, painful but containable. Then it hit the narrow neck. 24,000 unregulated banks that had lent money to those brokers absorbed the concentrated shock. No deposit insurance existed. No Federal Reserve lender of last resort support was provided. The neck cracked. And at the bottom, the contagion sprayed across the entire economy. 9,000 banks failed over 3 years. The money supply collapsed by 33%. Business lending halted. Consumer confidence shattered. 84% of Americans who never owned a single stock lost everything anyway. This is the chain reaction that turned a stock market crash into the worst economic disaster in modern history. The crashed market destroyed $30 billion in paper wealth in weeks. That triggered margin calls and bank losses as brokers collapsed and took their lenders with them. That triggered depositor panics. The first wave hit in November 1930, over 9,000 bank failures followed by 1933. That triggered a credit collapse. The money supply violently contracted by roughly 1/3. Business lending stopped completely, and that triggered industrial collapse. Demand died. Industrial production fell 47%. Unemployment reached 25%. One crash, 5 dominoes, a decade of suffering. And then America made it global. On June 17, 1930, President Hoover signed the Smoot-Hawley Tariff Act, raising tariffs on over 20,000 imported goods, ignoring a petition signed by more than 1,000 economists begging him not to. Europe retaliated immediately. Global liquidity, already strained by German war reparations and gold standard hoarding, evaporated entirely. World trade plunged 65 to 66% between 1929 and 1934. American exports to Europe collapsed from $2.3 billion to just $784 million. A Wall Street crash had become a worldwide economic catastrophe, and one signature made it infinitely worse. Before we close, let us separate what popular history gets wrong from what actually happened. The folklore says the crash caused the Great Depression. The fact, it was an accelerant. It was the banking failures and the Federal Reserve's monetary contraction that turned a recession into a decade-long depression. The folklore says brokers jumped from Wall Street windows. The fact, that is pure journalistic legend. Contemporary data shows no meaningful spike in suicides in October 1929. The folklore says Black Tuesday was the worst single-day drop in history. The fact, Black Monday the day before was actually worse, and the 1987 crash dwarfs them both at -22%. History is messier than the myths we tell about it. Here is the full scale of the destruction. The Dow Jones fell from 381 at its peak to just 41 at its trough, an 89.2% annihilation. The gross national product collapsed from $103 billion to $55.6 billion. Unemployment went from 3% to 25%, 12.83 million Americans out of work. For those who kept their jobs, wages fell 42.5%. And Goldman Sachs Trading Corporation, the ultimate symbol of extreme leverage, fell from $104 per share to $1.75. Numbers on a page, but behind every single one, a family destroyed. Out of the ashes came accountability. 3 pillars of reform reshaped American finance forever. The Glass-Steagall Act of 1933 separated commercial and investment banking, ending the era of reckless conflicts of interest, and created the FDIC to prevent depositor panics from ever destroying the banking system again. The Securities Exchange Act of 1934 created the SEC, finally bringing transparency and regulation to a market that had operated in the dark for decades. And the Pecora Commission, the Senate hearings that exposed Wall Street's abuses to the American public, marshaled the outrage necessary to force all of it into law. The Dow Jones Industrial Average finally reclaimed its September 1929 high on November 23, 1954. The wait took 25 years and 2 months. Some lessons cost everything before they are finally learned.